Welcome back to the channel, and I want you to listen very carefully to what I'm about to say because most people are not ready for this conversation. XRP is setting up for a scenario where supply doesn't just tighten, it disappears. Not slowly, not over decades, but fast enough that a lot of people are going to wake up one day and realize they completely misread what was happening right in front of them. Now, before you roll your eyes and think, here we go again, another XRP moon video, slow down. That's not what this is. This isn't price predictions pulled out of thin air. This isn't opopium. This is about mechanics, how liquidity moves, how institutions behave, and why 2026 is shaping up to be a very different environment than what most retail investors are used to. When I say XRP could start vanishing overnight, I'm not talking about some magic burn or a sudden announcement that sends price vertical in one candle. I'm talking about supply shock dynamics, the boring, unsexy kind that only shows up after the damage is already done. The kind where by the time Twitter realizes what's happening, the positioning window is already closed. Here's the uncomfortable truth. Most people think supply shock looks like price first, fundamentals later. That's backwards. Real supply shocks start quietly. They start with custody, with balance sheets, with institutions locking assets away where you don't see them on an exchange chart. And then one day, liquidity dries up, not because demand exploded, but because available supply quietly vanished. And 2026 is lining up to be the year where multiple forces collide at the same time. In this video, I'm going to walk you through exactly what those forces are. I'm going to explain why this isn't a retail-driven narrative, why memes and hype don't matter here, and why the biggest signal isn't coming from XRP influencers. It's coming from the people who spent the last decade mocking crypto and are now quietly integrating it. I'll also show you how I'm personally thinking about positioning for this environment, not in terms of Allen or sell everything, but in terms of timing, patience, and understanding cycles. Because if you don't respect cycles, the market will humble you every single time. Now, let's address something up front because I don't sugarcoat reality here. We are not in a supply shock today. If anyone tells you XRP is already in a supply shock, they either don't understand liquidity or they're lying to you. Right now, global conditions don't support it. Liquidity is tight, interest rates are restrictive, risk appetite is muted. That's not when supply shocks happen. Supply shocks happen after pain. They happen when policy shifts, when money printing comes back, when interest rates roll over, when institutions suddenly have capital they need to deploy, and they deploy it into assets that already have infrastructure compliance and global reach. And this is where most people get caught off guard because while retail is watching 5-minute charts and arguing over whether XRP is dead, the largest financial players in the world are making structural decisions. They're not speculating. They're building systems. And once those systems are live, they don't care what price you paid or whether you believed early enough. One of the clearest signals of this shift came from someone who used to be one of crypto's loudest critics, Jamie Dimon, CEO of JP Morgan. For years, he dismissed crypto as useless, a fraud, a distraction, and now he's publicly acknowledging blockchain, stablecoins, smart contracts, and digital settlement as inevitable parts of the financial system. That's not a soundbite. That's a capitulation. And when people like that change their language, it's never because they suddenly had a change of heart. It's because the economics forced their hand. Now, let's slow this down and actually unpack why that Jamie Dimon shift matters so much. Because most people hear comments like that and shrug it off as, yeah, crypto is mainstream. Now, that's not the real signal. The real signal is what comes next, when banks this size acknowledge blockchain publicly. Jamie Dimon didn't just say crypto is real. He specifically talked about stablecoins, smart contracts, and moving value more efficiently for customers. That tells you exactly where the industry is heading. Banks are no longer debating if blockchain will be used. They're debating how much of the stack they can control themselves. And that's the key tension you need to understand. JP Morgan will push its own deposit token. Bank of America will want its own rails. European banks will want systems compliant with their regulators. No major bank wants to be dependent on another bank's proprietary token. That's not how competition works. But here's the problem for them. Fragmentation kills efficiency. If every major institution issues its own token, you still need interoperability. You still need a neutral bridge that can move value across systems without forcing one bank to trust another bank's infrastructure. And this is where the conversation quietly circles back to assets like XRP. Not because XRP wins everything, not because Ripple replaces banks. That narrative is fantasy. What actually happens is much more subtle and much more powerful. XRP doesn't need to be 100% of anything. If XRP becomes even a small percentage of cross-border settlement flows, tokenized real-world assets, or liquidity bridging between institutions, the demand profile changes completely. 10% participation in trillion-dollar markets is not small, it's enormous. And this is where people underestimate scale. Now layer this with what Larry Fink and BlackRock K are saying about tokenization. When the CEO of the world's largest asset manager says tokenization is entering its pre-boom internet phase, that's not marketing talk. That's a roadmap. Tokenization isn't about hype. It's about efficiency, custody, compliance, and settlement. It's about turning illiquid assets into programmable, transferable value. And again, no single company controls that future. Every player builds their own tools, their own platforms, their own compliance frameworks, but the plumbing underneath still matters. This is where Ripple's strategy starts making more sense to people who actually think long-term. Ripple isn't just selling software anymore. They're building infrastructure, Ripple Prime, custody services, treasury tools, and most importantly, the conditional approval for a Ripple National Trust Bank. That piece is massively misunderstood. This isn't about Ripple becoming a bank in the way retail imagines it. This is about competing on equal footing with institutions like JP Morgan, BNY Mellon, and State Street when it comes to custody, settlement, and trust services. If you don't have regulated infrastructure, you don't get institutional flows, period. And here's the part most people miss. Banks don't wait for perfect clarity. They build before clarity fully arrives, so they're ready when the switch flips. Now zoom out and connect this to macro conditions because supply shocks don't happen in isolation. Right now, liquidity is tight. Central banks are restrictive. Japan is tightening. The US is still fighting inflation. Risk assets struggle in this environment. That's normal. That's not failure. That's the cycle. But historically, every time Japan tightens aggressively, assets get hit first and then outperform later when policy reverses. Every single time. That matters because Japan sits at the center of global liquidity flows. So when you hear people say XRP hasn't moved yet, so nothing is happening, that's not analysis. That's impatience. What actually matters is timing. Supply shocks don't begin at the top. They begin at the bottom when assets are cheap, sentiment is bad, and positioning quietly shifts from weak hands to strong ones. Now, let's get brutally honest because this is where most XRP narratives completely fall apart. A supply shock does not happen just because big names talk bullish. It doesn't happen because Jamie Dimon changes his tone. It doesn't happen because Larry Fink drops a quote. Those are signals, not triggers. A real supply shock only happens when three conditions align at the same time. And if even one is missing, nothing explosive happens. Condition 1, liquidity has to turn risk on. Right now, we're still in a restrictive environment. Rates are high, balance sheets are tight, capital is cautious. That means even institutions that want exposure are slow walking allocations. They test, they pilot, they sandbox. That's why XRP adoption today looks underwhelming to people expecting fireworks. This phase is boring by design. The fireworks only come after easing begins, not before. Condition 2, institutional rails must be operational, not theoretical. This is where Ripple's recent moves actually matter. Custody, trust banking, treasury services, these are not hype products. These are prerequisites. Institutions do not move size until custody, compliance, and counterparty risk are solved. Full stop. Ripple National Trust Bank isn't a marketing headline. It's infrastructure that allows real money to move without lawyers panicking. Condition 3, and this is the one people underestimate the most. Capital must be forced to compete for limited supply. That only happens when flows accelerate faster than liquidity can be sourced. ETFs, treasury usage, payment corridors, tokenization settlement. None of these individually cause a supply shock, but when they overlap during a risk on liquidity cycle, that's when price stops behaving rationally. Now look at where we are today. We are not in that environment yet. Anyone telling you otherwise is lying to you or doesn't understand macro cycles. Today is positioning. Today is accumulation. Today is infrastructure being laid while sentiment stays divided. That's exactly how early stages always look. And this is where patience separates winners from exit liquidity. Let's talk probabilities instead of fantasies. An extreme scenario where XRP absorbs massive ETF inflows, payment volume explodes, and tokenized assets settle at scale can produce a serious supply crunch. But that requires coordinated timing, favorable policy, and liquidity expansion. That's not guaranteed. Pretending it is makes you reckless. A moderate bullish scenario, however, is far more realistic. One where liquidity eases, institutions allocate incrementally, and XRP captures a meaningful but not dominant share of settlement flows. In that environment, double-digit XRP prices are not crazy. They're plausible. They're earned not overnight, but over a cycle. And here's the uncomfortable truth most influencers won't say. If XRP ever goes parabolic, it will not feel safe. It will not feel obvious. It will not come with confirmation for retail first. By the time it's comfortable, the easy money is already gone. That's why this phase feels frustrating. People want certainty. Markets only offer probability. And probability right now says this: the groundwork is being built, but the trigger hasn't been pulled yet. So what's the correct mindset? You don't chase, you don't panic, you don't mortgage your future on opium, you prepare, you assume volatility, you assume setbacks, you assume manipulation in thin liquidity, and you position yourself so that if the supply shock arrives, you're already seated, not scrambling. Now let's talk about execution, because this is where almost everyone blows it. Not because they didn't believe in XRP, but because they had no plan once emotions entered the room. Most people say they're long-term holders, but what they really mean is they're reactive. They buy when narratives feel good, freeze when price drops, and sell the moment volatility feels personal. That's not strategy. That's hope dressed up as conviction. If you actually believe XRP is positioning itself for a larger role in global finance, then your behavior has to reflect time, not tweets. Real accumulation happens when price action is boring, sentiment is split, and conviction feels uncomfortable. That's where we are now. Not early euphoria, not late blow-off, the messy middle where patience gets tested. Here's the part people don't like hearing. If XRP really is setting up for a meaningful supply squeeze later, the market will almost certainly try to shake you out first. That means fake breakdowns, slow grinds lower, long periods of nothing, and sudden volatility spikes designed to trigger emotion. This isn't conspiracy. It's how thin liquidity behaves when larger players are positioning quietly. So what does a rational approach look like? First, you stop anchoring to exact price targets. $10, $25, $100. These numbers are meaningless without context. Price doesn't move because a number makes sense. It moves because liquidity floods in faster than supply can respond. Until that happens, obsessing over targets only damages your decision-making. Second, you think in ranges and phases, not single outcomes. Accumulation phase, expansion phase, distribution phase. Right now, XRP is still fighting to exit accumulation. That's why breakouts fail and rallies get sold. When the phase changes, the behavior changes with it and that's when you press, not before. Third, you manage risk like an adult. That means assuming you could be wrong. It means not going all in at one price. It means leaving room for downside without emotional damage. Anyone telling you this is the last chance forever is trying to hijack your fear, not help your portfolio. And here's the most important point. Even if XRP does everything bulls hope it will do, most people still won't benefit. Why? Because they'll sell too early, overtrade, or abandon the thesis during boredom. Markets don't reward intelligence alone. They reward emotional discipline. If the macro environment flips in 2026, easing stimulus, institutional acceleration, XRP won't ask for your permission before repricing. It won't give you a polite warning. It will move when positioning is already done. That's how asymmetric assets behave. So the real question isn't, will XRP supply shock? The real question is, can you hold a position without needing constant validation? Because if you can't sit through uncertainty, you don't deserve certainty on the upside. So let's land this properly without fantasies, without hype, and without pretending this market owes anyone anything. XRP doesn't need to go viral to succeed. It doesn't need influencers screaming targets. It doesn't even need retail participation in the short term. What it needs, and what is slowly forming, is structural relevance. Pipes, rails, custody, settlement, compliance, boring things, unsexy things, the kind of things that don't pump overnight but quietly change how money moves. If that transition accelerates the way history suggests it does when liquidity turns back on, then yes, price will eventually reflect it, not because of belief, but because supply and demand stop being theoretical and start being mechanical. But here's the hard truth most people won't say out loud. Even if XRP does everything right, there are no guarantees. Markets don't pay out for effort, loyalty, or patience alone. They pay out when positioning aligns with timing, and timing is ruthless. That's why discipline matters more than conviction. You don't need to predict exact tops. You don't need to catch perfect bottoms. You need a framework that keeps you rational when volatility returns, because it will. If XRP runs, the same people screaming now will tell you it's too late at $5. Then guaranteed at 15s, then just the beginning at 25s. That's how cycles work, and that's where most people give back gains. The smart move is boring. Plan entries before euphoria. Plan exits before greed. Size positions so you can sleep at night and accept that missing some upside is far better than round-tipping everything. If XRP never delivers the upside people dream of, you'll survive if you managed risk. If it does deliver, you'll only benefit if you didn't sabotage yourself along the way. And that's the part nobody wants to confront. Your biggest enemy in this market isn't manipulation, whales, banks, or narratives. It's you reacting emotionally to uncertainty. So take a breath, zoom out, stay objective. Let the data guide you, not the noise. And one last thing, because it matters. Everything discussed here is for educational purposes only. This is not financial advice. Markets are volatile, crypto is high risk, and you should always do your own research before making any investment decisions. Never risk money you can't afford to lose. Stay sharp, stay patient, and don't confuse conviction with recklessness.